Part of the show is bringing attention to institutions that you may not know about. And I feel that one, it's a great symbol of that is Performance Trust Capital Partners here in Chicago, an institution that I've been getting to know better. That's a big role in the banking world here in the Midwest. We have the CEO, Chirag Shah, joining us from Performance Trust, PT as it's known here. Chirag, it's great to have you.
Very great being here. I appreciate the invite out.
Bringing the attention to kind of underappreciated gems. I mean that in the best way possible, because I want to give some numbers for context for what you guys do. You're a bank, you're trading and execution. You did $100 billion in securities trading annually on an average basis the last 5 years. From an M&A side, you guys did 170 advisory deals since 2013, and your origin is kind of a bank to the banks. So as you've grown, how do you describe Performance Trust to people when you say the 60-second kind of elevator pitch? This is who we are today.
Sure. I'd say at our ethos, we do something very simple. We help community financial institutions make better decisions, right? So the world has gotten a lot more complicated on the financial space with more products, AI, other things that are happening rapidly. And what we are in many ways are guides, but through an analytical framework that on average we see institutions that work with us, they outperform in the tune of about 100 to 150 basis points of ROE over time. And the reality is that there's asymmetric trades that are available, asymmetric capital allocation possibilities that are available there. And sometimes you just need more simple, elegant frameworks in order to better identify them.
Okay.
Just one thing, just a little bit of a correction.
Yeah.
Given that we work with about 1,200 community financial institutions, a lot of times people confuse us for being a bank ourselves.
Sure.
So we're actually not a bank, but we work with about 1,200 community financial institutions. On top of it, probably about 1,000, hedge funds, money managers, non-bank originators alike to really help them access capital markets, help them access securitizations across a broad spec of the financial landscape.
You do a lot of work with balance sheets on behalf of those financial institutions. And tell me about when you say kind of the community banks or the regional banks, how should we think about that profile of client that you're mostly working with? What does it look like?
Yeah, so if you think about it, if you go to Canada, for example, in Canada, they have 5 big banks. In the U.S., do you have an idea how many banks and credit unions exist? What's your guess?
Thousands.
Thousands. Almost 9,000.
Okay, I was going to say 10.
Okay, 10. You'd be right there. And the reality is, the big banks, JP, B of A, they do a lot of the business that's there. But if you talk about small business lending, over 50% of the small business loans are being done by these community financial institutions. There's probably about 8,500 of them that are really driving the heartbeat of our community. And we partner with that long tail to build out ubiquitous decision-making frameworks that we partner with them on to try to help them figure out how do we make better capital allocations across their whole balance sheet.
Okay. And so where is that line then between the definition of a bank or an advisor or a separate entity? Because it seems like a lot of things that you're doing, you're going to be competing with traditional banks.
Yeah, I'll tell you what, all lines are blurred. So I take a look at somebody like Apollo.
Okay.
Apollo, you wouldn't think of as a bank at all.
Okay.
But the reality is, last year in 2024, they originated $225 billion in loans. Right? They're stepping into this big void of private credit and are starting to dominate. And they actually made more money from net interest margins, from earning like spread versus collecting fees on assets under management, right? So in a way, they're working to displace banks. Now, what we do on our side, we don't actually do lending.
Okay.
What we do is we actually identify pockets of capital of people who need cash, like a non-bank originator to run their businesses, right? Or people who might need lending. And we identify different people who have money that can invest into them, right? It could be retail. It could be, in most cases, it could be banks. It could be hedge funds or others. And we help actually put together win-win solutions on both sides.
Okay.
So what they don't have to worry about is us stepping in front of them. But that's why we have such trusted partners in the tunes of about like 3,000 people, that institutions that we work with on a day in, day out basis to do a lot of the work that we do.
I've seen you guys' trading floor. It's
Yeah.
very impressive.
Yeah.
There's about as many Bloomberg terminals as I've seen since I was at Bloomberg.
Yep.
And that's where I kind of describe you guys as sort of a hidden gem in a way.
Yep.
You have a trading floor that is finding what you guys describe as those asymmetries and a style of trading that you guys liken to Moneyball, and so much so that you guys' event had Billy Bean speaking at the event. You
Yeah.
guys have bankers that come from all over
Yeah.
to hear about what you're doing. You're also big on education with Performance Trust University. Tell me more about that label and that style of what you guys call Moneyball. How did you get to that? And what did Billy Bean see where he said, okay, actually, yeah, this is similar to what I'm doing?
Yeah, it was very validating. You know, Billy Bean gets asked to come to a lot of places, and so it was great when he was like, "Hey, I'm looking forward to coming out," because one of the things he started to see, in the same way he identified asymmetric risk rewards and took action, he started to see that's what we're doing with banks. And he was talking to our founder. He goes, "You know what? We've been around for 30 years." He goes, "Huh? You guys are essentially doing Moneyball for banking."
Okay.
And when you take a look at Billy, he did something pretty simple. You know, he took a look at this industry. It had this embedded culture of making decisions, of using flawed tools. And all he did was exploit this industry by using publicly available information. He didn't have secret data, anything like that. He took publicly available information, put it together, and took a look at it through a new lens to take action. So in a very similar way, you know, as opposed to using traditional statistics in finance, such as yield and duration, we take a look at different things, such as total returns, different scenarios, different time periods, count all the cash flows. And we built it through a systematic way that we can repeat and actually help institutions make better financial decisions. And so I think for us, when Billy came in, and you know, for him, in a big way, he talks to a lot of people. But for him, when he got to see that he's talking to the community leaders that are doing the lending, that are driving the small business lending, he's like, hey, this is ethos aligned, both from a impact point of view in terms of, yeah, we're actually doing something differentiated that's leading to better returns. And it's actually really helping the community at the same time. So It was wonderful to have him come out and join us.
Some of the things that you're talking about in terms of finding those opportunities and then stacking them to, create a scale over time through those asymmetries. I always kind of have this bias because I'm a poker player, and we had a guest on yesterday. We're talking about similarities with poker trading, and we had Pedro Bacasol from Whole Tactical. Blair Hull is a blackjack player, and a term that we use at the table a lot of time is leaks. Right? You want to plug leaks, you want to find your opponent's leak. Now, when you're talking with clients and you're looking at these community institutions and these banks, what are their common leaks? What are those leaks where you can say, okay, here's our expertise in the world of bonds or whatever it is that we're finding? Is there a commonality in what those leaks are that you guys specialize in plugging?
Yeah. So in Chicago, what's going to happen here in 3 months? What's going to happen in Chicago?
Well, we were talking about having a major political. I've got my mind set on an event that's going to take shape next year, which is the new governor race, obviously.
So that could or could not happen. We don't know. But I'll tell you what's definitely going to happen in 3 months. It's going to be freezing cold.
Okay.
Winter is coming,
Cold.
right? So you know that with certainty.
Okay.
But what's amazing, the certainty that we know with weather.
3 months, that might be a little sooner, by the way.
Yeah, that's a good point. But it gets cold here. But what I'll say is, a lot of times, if you take a look at assets right now, it's being priced in with a certain amount of rates down cuts that are going to happen. And people look at that. A lot of the banks that we look at that and they say that's gospel. It's going to happen. They're pricing assets to perfection like that's going to take place.
Okay.
Now, if you take a look back at banks, if you take a look at their total returns over the last 7 years for regional banks, they've barely covered their cost of capital, right? It's been poor. It's been poor performance overall. And a lot of it has to do with the rate bias of what's going to take place. So a lot of times what people will do is guide their institutions based on what they think is going to happen with the economy and not take a look at a series of outcomes that could happen and actually identify, well, what are my risk factors, right? Because during this last 7 years, there's been no credit cycle. There's not been a credit cycle since 2008, right? So you think about not covering your cost of capitals, and there has not been a credit risk cycle. But what happens if rates don't go down by 100 basis points? What happens if a credit cycle comes up? are you prepared of actually putting around moats to protect yourself? So I think that's one of the big things is how do you create durable returns over time? And that's what a lot of times people miss, and that's very important to align ourselves with when
Are they
working with
thinking
institutions.
too kind of like binary when there's a spectrum of outcomes and you can find margin and profits on even kind of the tails of those outcomes?
That's exactly it. There's this ability to actually spot asymmetric risk rewards a lot of times at those tail scenarios
Right.
where you have a lot of mispriced options that are taking place. So I think that's the key is just understanding the broader landscape, the broader outcomes that can happen with rates, with optionality, with credit, and putting in the spectrum in a way that you can see both the high amount of risks that are there by taking certain decisions and really work to de-risking many times the tail scenario so you have much more durable return.
Okay.
And not just get so caught up in trying to predict exactly where interest rates are going to go or where the credit cycle is going to go.
Well, I can definitely attest to your guys' and your team based on talking to people from PT that the way they think about bonds certainly is on a different level of sophistication. I say that as someone who fancies themselves a pretty good bond person.
Yeah.
I started my career writing about bonds. My last job, we brought sports producers over and we taught them about bonds as kind of the integral thing. When I talk to your people about the way they think about bonds, they think about it with like 100 sectors of bonds and the different classifications and slicing it in ways that I never thought about before. But tell me, as the last point here is, where's the puck going for PT? Where do you take this expertise and the communities that you've built up to this point? Where does that puck go next, and what interests you the most?
Yeah, so part of it is it's just not always on the 1 and 3 year horizon. A lot of times people are focused on what are going to happen with the cash flows, with the bonds, with capital raising, whatever it may be. But the reality is the world is changing rapidly over the next 5 to 7 years. And there's big decisions that they're making today in technology or regulation or other aspects that could really disrupt their business today, right? So I just think about fintechs. Fintechs used to be an overused, played out word that people talk about a lot. And people didn't really take it seriously until you look over across the pond at London, for example, in UK. The 4 biggest banks have lost close to 25% of their market share in the last decade, and not to other banks, but to neobanks, right? To new fintechs that are popping up. And a lot of the reason there's been this moat in the US is that there's been a lot of regulation that's been protecting banks from that. But you see what's happening with the new administration, how things are changing. And
Talk
there's
to Bart Smith about stable coins.
Stable
Someone
coin
from
and
your guys' team.
yeah, stable coin and other aspects that are starting to come through. And so you need to have your day-to-day blocking of tackling of your capital allocation locked down, right? Accessing the capital market when it's open. Right now it's open. Taking out that insurance so you have optionality in the future. Understanding what to do, but at the same time, need to be prepared for where the puck is going. And it's just getting a lot more complex.
Yeah.
And so that's very important, not just to get caught up in the numbers, the dollars, the cash flows of what's happening, but understanding the bigger strategy of what's changing and what place are you going to play within it.
Yeah, very cool stuff.
Yeah.
We're going to come along for the journey. Hopefully, keep us posted, and we'll be in touch, Chirag. Thanks a lot.
All right. Very good to be out here. Good seeing you.
Absolutely fascinating conversation. We're going to go from bonds into options. Chirag Shah, the CEO of Performance Trust.